any form of exchange whatsoever is regarded as forex. So it doesn't have to be online. It could be physically. So there's a lot of reasons why people exchange currencies, and some of them are listed here. It could be for commerce, for traveling, for vacations, for trading, and so on. So companies oftentimes exchange currency with other, maybe buy forex from other countries if they need to um, purchase goods from those countries and all this. So for traveling, vacations, all of that. So further on in the course, we'll see why or how it's possible for us to trade forex, because we're not actually owning any of these commodities. It's not like we're holding the money cash in our hands or stuff like that. So now, what are CFDs, which is part of the topic here? So CFDs stands for contract for difference. So this is an agreement between a buyer and a seller, which states that the buyer must pay the seller the difference between the current value of the commodity and the value at the time of purchase. So this is just like it's almost the same as trading forex. Yes. So at whatever price you were to buy or sell whatever commodities was, your profit or your loss is determined by the price difference. So the difference between the price at which someone buys and the price at which you sell it is going to be going to be what will be paid. So it's either you pay to the seller or the other person pays to you, depends on who is losing. But between you and the other person on the, so it's like you take a buy position, someone else takes a sell. So whoever wins between the two of you takes the money more. So that's more or less what it's saying is. So this is a way for traders or investors to trade on the value of the commodity without actually owning the commodity. Okay, so when when people take part in forex, maybe real life, I mean cash transfers, buying stuff abroad and all of that. That causes the value of those currencies and all of that to move. Yes. But then when we buy or when we're trading as traders, when we trade or when we buy or sell, we do not actually own those commodities. We are just buying the value of the commodities. That's why we can take either a position to buy or a position to sell. But then in real life scenarios, you can't own or you can't sell what you do not already own. But then in this case, you don't have to own the currency or the commodity before you can sell it or buy it. So you're just trading on the value of all those commodities. So why must we learn about the contract for differences? Why must we learn about CFDs? So first point there is CFDs and Forex are very similar with almost no difference. So we'll see the differences and similarities later on because then CFDs are a modern alternative to purchasing special commodities. Now what this means is back then, say a couple of years back, the forex trading wasn't available to just everybody. It was for a specific set of people. And then if, for instance, you want to buy a stock or a share of a company, as in Tesla, for instance, you would have to maybe go to your broker. And your broker must go to the company and purchase shares, which gives you actual percentage ownership of that company. So it means you actually own the share at Tesla. You understand? So if I wanted to buy maybe 10,000 worth of shares from Tesla, then I would have to go there and purchase, and then I would actually own 10,000 worth of shares from Tesla. So that's going to be a lot of that's going to be very difficult because I mean it won't be easy to having to go and purchase your own shares and all of that. So that's why this is important now. So CFDs have given you a way of purchasing those shares without actually owning those shares. So you're just trading on the values of those shares, but you don't actually own the shares. So if somebody, for instance, today buys 5,000 contracts of Tesla, for instance, on his mobile phone, he doesn't actually own 5,000 shares with Tesla. He doesn't even own a share with Tesla just by that trade. But he's just trading on the value of the shares, of the actual shares of Tesla. So you're not actually owning it. So CFDs makes it possible for a trader to benefit from either movement in the market, long or short. Like I said earlier, you don't own any of the commodities you trade on. So you could take either position. So in a real life scenario, if I want to sell my shares at Tesla, I must own the shares at Tesla. So it will be possible for me to sell what I don't have. But then because trading CFDs doesn't means that you don't actually own the commodity you're buying or selling. Then it means you could take any position on it because you're trading on the value of it. So if you're expecting the value to maybe drop, you could take a position to favor you on that decision. If you're expecting value to go higher too, you could also take a decision to favor you there. So you don't actually own it, so you can take either position. CFDs offer you a large variety of instruments, which helps diversify your portfolio. Okay, what this means is, okay, if we didn't have CFDs now, you may be limited to trading maybe just buying shares from one company or the other. But then now with this, you could trade in a lot of things. You could trade in metals, you could trade in indices, you could trade in energies, a lot of things you not really imagined before. So CFDs give you a means of accessing a wide range of instruments to trade on in the market. So trading CFDs is far more risky than trading Forex. Okay, we have to understand this one now. So later on in the course, you get to understand why we say trading Forex is less has carries less risk than CFD trading. So a brief uh, so a brief um, difference and between Forex and the CFDs. So if you can't get the audio properly, try and reconnect. Also. Hmm? Sorry. Okay, so let's move on. Now I'm going to give the differences between the Forex and the contract and a few similarities also. So the Forex is limited to just currencies only. So anything that goes outside any country's currencies, for instance, if it's not within maybe Euro USD, GBP USD, like these ones that are here, anything outside this, maybe not just this set, because there are a lot of currency pairs. So all of them that are paid as a country's currency versus another country's currency. Those are all Forex. But then CFDs have a wider range of instruments for metals, indices, stocks, energies, and so on. You could see trading gold or silver or the Dow Jones Index, Nasdaq, and a lot of things. Tesla shares, Apple shares, Samsung, all of them, they're all CFDs. So you have a wider range of instruments to trade from on the CFD side. Yeah. Forex involves trading in uniform lot sizes. So you may not know what lot sizes are now. So just take note of this. Then further on in the course, we would break this down. CFDs allow you to select different contracts that vary in value depending on the originating country. Now, the value of each contract for each of these CFDs depends on the countries they come from. For instance, now an indices in US, the value of the contract for an indices in US would not be the same as the value of a contract for an indices in Japan or say China, for instance. So the countries determine the value of the contract. Unlike Forex, Forex has a uniform value everywhere. So even if you're trading euro against the US dollar or the pound against the US dollar, the value of each lot price stays the same. So Forex market is influenced by sorry, let me try and okay, sorry. So the Forex market is influenced by demand and supply and demand, but it's also is hugely influenced by economic events. What it means is the normal forces that move the market are basic demand and supply laws. That's increase in demand causes price to rise and all of that. But then the forex market is also largely influenced by economic events. For instance, say there was a war. Those are economic events that could affect the forex market. So you'd see the forex market react massively to such events. Those are the economic events, some news events, and all of that. Then the CFDs, they're generally influenced by demand and supply, but they may or may not be affected by economic events. So it means some of those events that may affect the forex market may not affect the CFD market. So you could notice higher volatility in the forex market. At the same time, there will be no volatility in the CFD market because the events may not affect the CFD. At times they do, but then that won't be all the time. So sometimes the events may affect the CFD market, but they don't. But then the CFD market is generally based on demand and supply. That's 80% of the time. So a few similarities. The CFDs and Forex have a similar trade execution process. So the CFDs and Forex have a similar trade execution process. Okay, let's go on. CFDs and Forex have a similar trade execution process, which means that the same way you take positions on the Forex is the same way you take on CFDs. So given the differences, there's no difference between how you can place the trades on Forex and CFDs. They're the same process. CFDs and Forex can both be traded on the same platform or the same broker that is providing the service. So it means for you to trade Forex and CFDs, you could do them on the same broker. So you don't have to get a different broker for your CFDs or a different broker for Forex. But then we'll discuss more about the broker later on because in both cases, the trader doesn't actually have ownership of the underlying asset. Like we have said earlier, for you to be able to buy and sell Forex or CFD, you don't own the assets. You're just trading on the value. So buying the US dollar against the euro doesn't mean you actually own the US dollar. You're just trading on the value. So let's move on. Okay, so why must we learn or why should we learn Forex trading? You can make money at any time. Here I have the Forex market is open round the clock. You can trade at any time. It is very flexible, which means you can trade part-time or as a full-time trader. There is potential for profit 24 hours a day. So because of high liquidity, there is always movement in the market, and there's always an opportunity for you to take a position. So there's no time where the market is closed, except hours where the market is meant to be closed, which is the end of the day and on weekends. But then 24 hours a day, the market is open, and 5 days a week, the market is open. So you don't trade Forex on weekends. But then at any time of the day, assuming you work 9 to 5, by 6 p.m., you could take a position. Assuming you're free earlier in the day, you could take a position earlier in the day and rest for the rest of the day. That's what I mean. Now, low transaction cost. Trading Forex and CFD is offered to you at okay. Trading Forex and CFD are offered to you at very low cost. You only pay a token for spreads or commissions to your brokers. This depends on the leverage, which we will discuss later. So most of these terms are terms we would come to understand later on. But then for any trade you have to place for in maybe it forex trade or for any CFD, you don't pay you don't the cost for spreads or commissions are very, very minimal. You may hardly notice it in fact, so that's an advantage. The market can't be manipulated. Like I said earlier, being a decentralized means of a decentralized market, a single individual cannot manipulate the market. So there's no owner of the market. So we can't have a situation where one person is able to manipulate the prices of any commodity at any time. Whatever happened maybe due to a lot of investment or demand or supply, but then no individual can manipulate the market because of the level of liquidity. And so let's move on. Sorry guys for the okay, if you guys have any questions, you could, as we go on, you could just maybe type out a question in the chat, and subsequently we'll be able to answer your questions. So you don't have to wait till the end of the lecture before you could ask your questions. So okay. So now moving on. The forex market is a leverage market. What it means is you don't need to afford the full price of a commodity to get to trade on leverage. Leverage is a term we would understand further on in the course too. So this means that a small deposit can control a much larger contract value, giving you, the trader, the ability to make larger profits. Let's assume, for instance, a contract is meant to cost you $1,000. This means that you don't need to own $1,000 as the trader before you should be able to take that. You should be able to take that position. That's the advantage of the leverage market. If, for instance, the leverage is 1 to 5, this means Make it again. I think it's fine. Mm. 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 Okay. Okay. Sorry. Okay. We're saying we're talking about the leverage market. So the forex market is a leverage market, which means you don't actually have to own the full value of whatever you intend to purchase at any time. So assuming, for instance, let's say for instance, the contract costs you, or a contract is meant to cost you $1,000 to be able to purchase that contract. With leverage, you could own $10 and end up purchasing the contract of as much as $1,000. That's the leverage. The leverage is like a multiplication of the actual or your actual deposit or your actual capital. So that's an advantage of the forex market. It means you don't have to have such huge funds before you can take large positions. Now there are no taxes. What this means is government doesn't take any taxes for your trade or brokerage agencies or the exchange commissions. So your trade, you get the full value of any of your positions, except for maybe spreads, which are the little you pay. So there's much very high liquidity, as we said on and on before. So so much liquidity keeps the market open and accessible at any time. You can never get stuck. You can never get stuck on a trade. You can never get stuck on a trade unless during the market inactive hours. We're going to talk about this particular aspect later on because so you can manage your trades at any time. So it means at any time, at any point in time, if you are satisfied with what you have or you're okay with your trades or your profits, you can close at any time. So you're not compelled to hold your positions longer than you want to. So now the next thing we're going to talk of is the key market players. So the forex market was originally intended to be accessible only by large institutions, big banks, but it was never meant to be accessed by retail traders like us. But then due to the advancement in technology, brokers have been able to make the market accessible to everybody. So then a few years ago, it was only people that had a huge sum of money that could access the forex market. It's almost like saying you want to buy you want to buy a share, but then you don't have enough money. So in a situation where there was no forex trading, you must have the money to buy that share. So if, for instance, a share in Tesla currently costs you $700 to purchase, now it means in real life you must have $700 to purchase that. So then it was only big institutions and the big banks, that's what we call them, the big banks, that were able to trade forex. So the key market players like we have here, we have the big banks, then we have large commercial companies, the government and central banks, then we have the retail traders. So now what do we mean by the big banks? The big banks, examples of them are down here. We have the Bank of America, Goldman Sachs, JP Morgan, Citibank. All these are the big banks in quotes. So being a decentralized market, the exchange rates are determined by players with the most stake in the market. So we call them the big banks because they have a lot of capital and their trading volumes are very high. So at any point in time, if they want to influence exchange rates, for instance, then they may have they can do it by trading. So trading in large volume like that is easily it makes it possible for the banks to affect the exchange rate and determine exchange rate. So if it's not favorable, if they want it favorable for them, they know how they can make it possible by maybe reducing or increasing the volumes they trade at that time. The big banks have the most stake in the market because of the amount of capital they can afford due to the numerous amount of customers they have and trade for. So the big banks also involved in trading, but then they have very huge capital and they have a lot of customers. So that's one of the main sources of the amount of capital they have. But then because they're in the big banks, because they largely affect the exchange rate in the forex market. Banks trade massive forex volumes of forex on a daily basis. They account for most of the volume traded daily. So I think this is self-explanatory. So let's move to the next. We have large companies like Samsung, Apple, Tesla. So what I have here is companies also take part in foreign exchange for commercial purposes. For instance, if Tesla wishes to purchase electronic parts from China for their cars, they would have to convert their base currency to the Chinese yuan before they can make such trades. That alone is forex. So having needing to make these purchases constantly puts them in constant forex market scenarios. So they're constantly engaging in forex trades like that. So these banks trade the trade volumes are much smaller than the big banks. So majority of the companies use commercial banks to carry out such trades. So if Tesla wants to buy yuan, for instance, rather than having to go to the big banks, they would trade them at the much smaller banks, that's the commercial banks and maybe the central bank. So moving on, the government and central banks. So the examples of the central banks that we all know what central banks are. We have the Fed Reserve Bank, that's the central bank in the US, the Bank of England, the European Central Bank, and the Central Bank of Nigeria, with a lot of other banks. So the central banks in every country take part in forex trading and they take part actively. The central bank regularly adjusts the country's interest rate to control inflation, which in turn affects the forex market. So in a case where the country's inflation seems to be rising, the banks the banks the banks increase the interest rate, and then this affects the forex market. So all of these are fundamentals. These are all economic events that we spoke of earlier on. So these are things that can affect the Forex market. So governments participate in Forex markets as well for their operations, for trade agreements, and handling the country's foreign exchange reserves. So I think this is self-explanatory. So we have retail traders, just like us. So most traders are retail traders. Retail traders can also be referred to as speculators. This is because any decision made by the retail traders at any time is based on speculation. What this means is, as a trader, you can never know what's going to happen in the next hour or in the next 30 minutes or in the next second. So any trade you place is based on speculation that is in hope that you you place that position in hope that you make some profit from it, but then you can never be assured of a profit. So as a retail trader, you can never know what's going to happen. That's why you need this training to better guide your judgment and increase your win probability. So knowing that it's not possible for us to know what's going to happen in the market before it happens, the best we can do is to try and increase the probability of us winning every trade. So that's the reason why we have to learn to analyze the market, technical analysis, fundamentals, and a lot of others that we'll look at later on. Because we cannot tell what's going to happen, we can at least minimize our risk and try and maximize profit for all the traders. So finally, what do you need to start trading? Unlike what we see on YouTube or a lot of other places, you need maybe a laptop or a smartphone. You could make your analysis on your laptop if you have one. If you don't have a laptop, there's no problem. You could still make your analysis on your smartphone. So it's not necessary for you to have a laptop, or the way you see it on maybe in pictures where you have multiple screens. There are different types of traders, but then with a laptop or a good smartphone, you could trade a very good and reliable broker. So the brokers are like the middlemen. They're the ones that offer you the opportunity to place all those trades and all that. There are a lot of scam brokers, but then there are a lot of legit brokers. So there's a lot of things to consider when choosing any of these brokers. So later on in the course too, we'll look at this. Then a stable internet connection. So for you to be able to trade effectively, your internet connection has to be very good. So, and you also need a good knowledge of the market. So definitely, you can't trade without knowing what exactly you're doing. So with a good knowledge of the market, you would be able to trade better. So I think this brings us to the end of this chapter for today. So on Thursday, we're going to look at other aspects of trading to kind of continue further in the course. So we're still on chapter 1 for this week. So this week we would be able to cover everything. But then this particular class was more or less kind of a trial. So most of the issues we had with the internet now, but definitely by Thursday next week, we won't be having all those issues. So sorry, by Thursday this week, we won't be having all of those issues. So we'll sort out most of the internet issues on our end and see how we can deliver better. But then, okay. So if there are any questions, okay, so I'm going to send the links to the recordings to your mails. So you'd have to be checking your mails regularly because we'll be sending materials to the mails. So I'll send the link to the recordings, the recorded speech. So I'll be sending the links to the recordings to your mails, and you'll be able to download the video if you're not able to get what I was saying clearly. CFD is the same thing as volatility. Volatility is an index. So yeah, CFD is the same thing as volatility. okay. Anything that is not correct, anything that is not correct, because anything that is not currency, yes, anything that is not correct at all is regarded as CFD. So anything that goes outside currency pairs, GBP, USD, Euro, USD, and that, they are all regarded as CFD. Yeah. So is there any other question? And we would like to have some feedback on how this session went. So it wasn't as much as we would have wanted, but then we would love to have some feedback to be able to improve in the next session. The subsequently we will be having most of all these messages. So as a recap, CFDs are almost like Forex. It was almost no different. The only difference may be in how the contract sizes are calculated and what is affecting the market mostly. But then there is almost no difference between the CFDs and Forex. But then trading Forex and trading CFDs will definitely feel different. For you to trade Forex, successfully, or for you to trade CFD profitably, it requires a much more higher level of skill than it would in Forex, because highly risky, and so that's that now. So if there are no other questions for now, then we would call it a day for now. But then if at all you have any inquiries whatsoever, we would be ready to answer your questions at any time. So you can send a message on WhatsApp or send email, whichever one. So we'll be ready to answer your questions. So just stay in touch. We'll be sending mails on any development or updates. So we'll keep you updated. Yeah. So if there's nothing for now, yes, that will be all. So we'll send the recordings and so thank you guys for joining. See you guys on Thursday.